Good afternoon, and first let me thank Mr. Contractor, Mr. Verma, for inviting us from the World Bank to participate in this event. It's something I'm very excited about because, when I first came to India to talk about pensions, there were two kinds of cars in India, the Maruti and the Ambassador. There were no private insurance companies operating. And more to the point, there was no EPS, there was no NOAPS, and of course, it was several years later that we even started talking about the NPS. So I think when one is embarking on a new initiative like this, which is a major paradigm change in the way you do something in a country of the size of India, it's really good to have some perspective, both temporal perspective and sort of international global perspective. So what I'd like to try and contribute a little bit today is to first getting some perspective on what's happening globally, because I think you'll see that it's very interesting to compare how things have evolved and are evolving in India with what's happening around the world. I hope you'll find it interesting anyway. And then talk specifically about what one could consider doing in the Indian context. Some of it is really loud thinking, as you say, but I hope it will provoke some discussion. So the title of my presentation is The Future of Pension Coverage in India, and I say Beyond Employment-Linked Pensions. I say this very specifically. We have a lot of terminological issues in pensions. One of them is we refer to pensions as contribution-based or contribution-linked versus non-contributory. In the case of civil service schemes, many of them are non-contributory schemes, so we couldn't call them contributory schemes. But they're all, the programs I'm talking about, whether it's EPFO or civil service pensions, are linked to your status in employment, formal employment in particular. And as I'll say in a moment, this is starting to come to a halt. It's coming to an end, I would say. And we're going to have to think differently in the future. So first I want to look at how we got to this conversation we're having today, and how we reach the limits of employment-based provision. Or maybe I'll convince you that we have reached the limits of employment-based, employment-linked pension provision. And then talk a little bit about where we're going. And I say we, not just in India, but generally speaking around the world. And some new approaches that are starting to emerge to do that. So first, I want to go back a little bit in history. I'm a student of pension history. I try to learn from it. I think it's actually turns out to be very useful and very relevant to things today. So the first thing I would point out is the British Civil Service Pension Scheme, which was, if you date it back, you can get back to 1689 in the Port of London when it first started. Now, it took its current form, or its modern form, shall we say, in the 1830s. Through a series of negotiations, it resulted in a non-contributory, there used to be contributions, actually, but it resulted in a non-contributory final salary DB scheme with a 50% replacement rate. Sound familiar? That was in the 1830s. That model was exported throughout the colonial world, and it still survives today in Bangladesh and Myanmar and Pakistan. So that was inherited at independence in India and continued until we got to the NPS in 2001 and then 2004 implementation. The other major historical trend in pensions was the introduction of mandatory schemes for the private sector. So the public sector almost always, in almost every country, had pension coverage first. And it was typically later that you introduced mandatory contributory pensions where you had a deduction from the payroll for the pension scheme. And that started in 1889 in Bismarck's Germany. And that was exported and adopted throughout the world over the rest of the century. More than 100 countries introduced these types of schemes. The United States was 1935, for example. And the most recent cases were Ethiopia in 2011 and 2015 in Indonesia, just last year. It may be the last, or maybe one of the last of these to be introduced. It's sort of the end of an era of expansion of these type of schemes. In India, we had the EPF right after independence in 1952, And that was later followed by the introduction of the EPS, which is the defined benefit scheme that covers the private sector in India. So when I came, the EPS didn't exist, but it did start in 1995. And it continues, obviously. Then we have a new phenomenon that I think Mukul would probably trace back to the Chilean 1982 introduction of mandatory defined contribution schemes, individual accounts, and privately managed individual accounts, as a matter of fact. And so this period actually starts earlier, but it was sort of by itself for a long time. It was only in the mid-90s that that type of scheme started to spread. And it also spread not only for schemes covering the private sector, but it was also introduced in many countries, or in a fair amount of countries, for civil servants. So right around the time, in the early 2000s, Hong Kong introduced the Mandatory Provident Fund, which covered civil servants. Nigeria converted their defined benefit scheme in 2004 to a defined contribution scheme, and Kenya did it last year. And I use these three cases in particular because they all started from an inherited British colonial civil service DB scheme. And sure enough, and the NPS was set up and announced in 2001 and then started to be implemented for workers hired after 2004. So you can see there's sort of, general trends that are going on globally that are more or less reflected in the case of India. Now, all of this is about employment-related schemes that involve contributions, either by the government, the employer, the employee. And those type of schemes, we've measured how much of the labor force is covered by that kind of scheme around the world. We measured it first in 1994, in the 1990s, mid-1990s. And so that mid-1990s line that you're looking at describes the relationship between income per capita and the coverage rate. The coverage is the number of people contributing to a pension scheme divided by the labor force. So, for example, the rich country, and it's a very tight correlation. So regardless of whether you had a Provident Fund or a DB scheme or whatever, the parameters of it, it was big, small, the coverage of those schemes tended to be highly correlated and continues to tend to be highly correlated with income per capita. And that's because formality doesn't depend on the design of a pension scheme. It depends on whether there's a large agricultural workforce, you have a large urban informal sector, and that's related to income per capita, which captures lots of different factors. So in the mid-1990s, the top line was the relationship between income per capita and coverage. Poor countries had low coverage, and they all had low coverage. Rich countries had higher coverage, and they all had higher coverage. The most recent time, we just did this last year with updated data. So you're looking at a 20-year period of change. And what we found was that adjusting for income per capita, this is purchasing power parity adjusted income per capita across countries, it's actually now harder to cover people with contributory schemes than it was 20 years ago. In other words, at the same income level, I will cover fewer people. This will predict that I cover fewer people. This is based on a 100-country, cross-country sample. So it's actually become harder to cover people in these employment-related, employment-linked schemes over the last 20 years. Look at India, and I did this figure a long time ago, and I've updated it sort of mentally with the data that I have from the EPFO, and it's maybe up at 7% now, so if you extrapolate this line, it goes there. But for these four decades, is it 4.5 decades, the coverage went from 1% of the labor force in India to 5% of the labor force. That means 1% increase in the labor force coverage every decade. We can't wait for 80 years to get to full coverage, and that's the pace that things are going for the last 50 years. So it's clear to me, and it's, I think, clear around the world, that if you want to cover people with a pension scheme before the country grows old, and there are many other countries growing old as well. China is growing old very quickly as well, Thailand, Vietnam, et cetera. You're going to have to do something different than the traditional Bismarckian model that we have lived with for the last 125 years. So one of those things that you're going to do is introduce what we call social pensions, or non-contributory pensions, some people call them. And as you can see, there's this general global phenomenon where for the first sort of 100 years here, there weren't that many of these social pensions introduced. So each dot is a country, and on the x-axis you have the years. But suddenly, there was a proliferation of these social pensions being introduced all around the world. Practically every country in Latin America did it in the last 10 years. Thailand did it starting 2009. I mean, I can go on. It's just exploded, the number of these things. India joined the group in 1995 with NOAPS. There were some state-level schemes before that, but in terms of making it national, it was in 1995. So that's part of that global trend as well. Now, the other reaction to this problem is to look at ways of getting voluntary contributions, and that's what we're really talking about a lot today. We put out a book about 2 years ago now, which reviewed international experience in, I don't know, maybe 15 countries, low income, middle income, high income, on what we call matching contributions. So this is the equivalent of Svalabdamam, I never can say it right, the matching contribution for an informal sector worker who is contributing to a pension. So we reviewed that, and we looked at some of the different types of approaches. So the New Zealand auto-enrollment approach is very famous, so there's a match plus the auto-enrollment. The Koreans, really, they had a situation where they covered most people with the main scheme, but they have a residual fishermen that aren't in the scheme, so they matched the contribution for the fishermen, and they got some of them to join up, and fairly successful. And the last case is China, and Shashank, you're right. If you go through this book, you'll find there aren't a whole lot of, big increases in coverage due to these schemes. They're all kind of not hugely successful, I would say. The one exception, though, is now China. So China increased coverage, I would say, from something like 25% to 60% in about 3 years. And what do? They have something, they did a match, plus if you joined and started making contributions, they'll pay your parent, who's over the 60-year age, a pension. So imagine that huge incentive. You're immediately, it's a kind of a strange, exotic type of arrangement. They call it family binding. But they basically pay a pension to the parent of the person who's voluntarily contributed to the scheme, and they increase by several hundred million their coverage. So they kind of combined these two things and did that. Now, we can get into the details of what it is. It's very low. I don't believe that the persistence is very good. And nobody knows, because data in China are very difficult. And you also have to factor in the fact, I talked to a Chinese official from a county once, and he told me he had 97% of the people were had contributed. And I said, well, what happened to the other 3%? And he said, well, we're going to talk to them next. So there's an element of coercion that you really, can't replicate, and you don't want to replicate, perhaps, in the Indian context. So there are a growing number of countries trying to do this. I've tried to list some of what I consider the generic success factors for doing this type of thing, expanding to the informal sector. One has been discussed very much today, which is public awareness. People have to know about it if they're going to be able to join it. Financial incentives, I think, are hard to get around. There needs to be some reward for giving up liquidity. These people generally value highly the liquidity, and so I think it does make sense. The OECD countries, the rich countries, use tax incentives. The only way you're going to get people to join a private pension scheme, a 401k or whatever, is through a tax incentive. Now, and some developing countries actually try to mimic that approach. But how many taxpayers are there in these countries? Very few. So it's an irrelevant incentive in my mind. In fact, I think it's a perverse incentive to have favorable tax treatment that only the top 5% of the population can use. And all they're going to do is shift around their savings anyway. If you really want to use fiscal incentives, get rid of the tax deductions for rich people and make a matching contribution for the poor person. You have to reduce the costs of enrolling. We heard some complaints about that it is difficult to enroll sometimes in these schemes, and that if you make it difficult, it's not going to happen. The transaction cost of then making the contributions has to be very low as well. On the supply side, you need to have somebody that's going to go out and enroll these people, that's going to be very proactive in getting them. We haven't seen that in the case of, for example, MPS Lite. There were some aggregators who took it upon themselves to really get their members and they thought it was a good thing, and they did it, but we were missing that piece, I think, to a large extent. You need to be able to have low-cost collection points, make it very easy for somebody to contribute to the scheme. And what Dr. Singh just mentioned, you really have to have good record keeping of those individual accounts. People have to know that you're not going to lose the record of all the money that they put in. And you have to have supervision, which we discussed, and a reasonable rate of return on investments. So, moving to situation in India, what are the considerations here in India? Well, first, the good news, as has been mentioned, is that there is the NPS and the architecture of the NPS, a well-thought-out architecture with a CRA, which is something we are actually talking to other countries about emulating, unbundling the record keeping from the asset management, from the rest of the supervision was, I think, I speak for myself, but I think many of my colleagues agree, a brilliant way of setting this up and something to be emulated. I think some of the Latin American countries wish now that they could have done it this way, and it's very difficult to do it in reverse. But there's this whole infrastructure now, which I think allows you to take care of these three at the bottom. I think you've got a robust record-keeping system. I think you've got reasonable rates of return. It can be improved, for sure. We can talk about the portfolio being better, but believe me, it's better than a lot of these centrally run schemes. I think it's a well-conceived system, and the supervision is taken care of. So we can take that maybe off the table to a certain extent. You can always improve it, but we've got the foundation, I think. So the back end, that I refer to that as the back end, is largely in place. The front end, I think, is where the work is needed. And the real hard work, I think, is on these four areas which are kind of overlapping. The transaction cost of enrollment, the transaction cost of getting contributions made easily, the motivated outreach to the members, which is part of the enrollment process, obviously, and so it's a sort of the demand and supply equation of enrollment and steady contribution collections, which are the two things you need, which are missing right now. So, recent developments, and I was working here with a couple of programs when I was living here in the late 2000s. One of them was Aadhaar, and the other was the RSBY scheme. And what has happened since has really changed what you can do. I think it's been mentioned, Will mentioned, and Anno this morning mentioned, what you can do with this new infrastructure is something we couldn't have done a few years ago. What was done with RSBY, which was a smart card, biometric smart card-based enrollment process, could not have been done even 5 years earlier because of the technology that didn't exist at the right price. So sometimes technology, and you're very fortunate that you have an intersection of certain projects and technology with an initiative, and I think this is one of those cases. And you can see some of the numbers that I've been given by the UID folks and others, 200 million Jan Dhan bank accounts. 65 million of those were set up through eKYC process, which is almost unbelievable how you essentially can go to the field and simply by verifying the identity of the individual, I can pull down the information that's necessary and open an account on the spot. That's something I don't know any other countries been able to do, and certainly not at that scale. So 90% of the population, as you know, has the Aadhaar number. We have lots of Aadhaar-linked bank accounts now, which facilitate all kinds of things. This JAM thing, I think, has incredible potential. We have all the cell phones you could possibly want out there, but that sort of still needs to be completely connected and having the ability to do mobile money and mobile transfers, but that's getting there as well. So you have this incredible infrastructure that is almost custom designed for expanding enrollment and in particular contribution collection for the informal sector workers, because I now can identify these people. There's no way I can keep track of things because the guy's moving all over the place. This makes him unique, both in terms of his identification, but also his bank account. It's really an amazing situation to have. So my last slide is this, and again, this is loud thinking. It's not a proposal, but it's something to start getting us thinking about how to utilize this to do what we're trying to do here. paperless, fast, secure enrollment brought to members. So EKYC, but for pensions, essentially. Proactive outreach by certain entities. We can decide who we're talking about here. But the RSBY program, what it did is it sort of, it discovered what the right price was for the distribution, in a sense. And what they did was they auctioned at a district level the right to go in and enroll, and then you will get paid on a per enrolled person basis. ADAR did it similarly, but not in this geographic sense. But you could consider doing something like that, because what happens is in the bidding process, you find out what is the market price for enrollment. Otherwise, you're setting an administrative rate, and that administrative rate is always going to be wrong because nobody knows what the market is, will do. In fact, when we did the RSBY, the Ministry of Finance set the cap at a certain level, and we were all very worried that when the bidding process started, the bids would not come below that cap. They came way below that cap. So, the market can sometimes work well in such a situation if you've managed it right. And then I think this concept of going to groups and perhaps doing auto-enrollment at the group level. So if you've got a welfare fund and you've got the infrastructure at that welfare fund, and there's a regular flow of money and information within that fund, you could ADARize it, you could ADAR seed it, and the next thing you know, you can start to have automatic deductions unless those workers opt out of it, which they can do. The auto-enrollment is not a mandate. You can, and it should be, you should make it relatively simple to opt out. Otherwise, it becomes de facto a mandate. But all the evidence shows that people generally just don't opt out. It's just they don't want to take the active decision of joining and filling out some paper to the hassle. But if you just opt them in seamlessly with no transaction costs, they will tend to keep contributing. We've got these micro ATMs that are starting to be used. This is a very nice way of making almost costless, transaction costless contributions come in. And we could look at even automatic deductions from some things that are being paid through DBT, like the LPG subsidy. And then my last word, I actually stuck this in after I heard the minister speak this morning on the behavioral nudges. So about 2 years ago, we did some work in Kenya, where they have a pension scheme for the informal sector that is paid through the M-Pesa, through the mobile phone. You pay very small amounts, very easily, low transaction costs. Unfortunately, they don't have any financial incentives, so it's not taken off. But there's a pretty decent number of people that participate in that. And so what we did was we randomized some intervention. So randomly, we sent some people SMSs. Others, we gave a little bit of a financial incentive, different financial level incentives. Others were given a coin. And there's a famous behavioral economist called Daniel Ariely. He's written some interesting books. And he came up with this idea, and we went over there. And he had a coin, and you'd have, for every month, there'd be a number there. And you'd scratch off the month when you made the contribution, when you made your limit. It's kind of like my Fitbit thing here. It reminds you, it gives you like a tangible reward that I've actually done something. And there are different ways of doing that. And the results are quite interesting. The coin was actually more effective than the cash extra payment. And some combinations of these things were more effective, so we combined the different ones here, like 10 different combinations. So it was an interesting experiment. I think we're going to learn more about how to do those things. I don't think my view is that it's no magic bullet here. It can increase things at the margin, particularly persistency and persistent contributions. I don't think it's going to give you this huge jump in enrollment. That's only going to happen through the other mechanisms that I mentioned before. So with that, I hope I start the discussion. There's some conclusions. I think I'm over time, sorry.